Russia wants the world to believe its economy is an unbreakable fortress that Western sanctions cannot breach. But on December 2nd, while Vladimir Putin was declaring victory on stage, his banking system was quietly bleeding out from a $136 billion wound that no amount of propaganda can heal. The disconnect between the Kremlin's rhetoric and the economic reality has never been wider. At the Russia Calling Investment Forum, Putin projected an image of absolute stability, claiming the economy had fully adapted to the war. However, the underlying data reveals a system that is reaching its physical limits. According to the International Monetary Fund, Russia's GDP growth has violently decelerated, plummeting from a wartime high of 4.3% in 2020 to a stagnating 0.6%. Projected for 2025, this is not a standard economic cooling. It is a structural exhaustion caused by an overheating war machine. While the central bank fights a losing battle against an inflation rate exceeding 9%, a far more dangerous fracture is forming in the financial sector. Data released by the Moscow Times on December 8th exposes the true cost of Putin's persistence. The Russian banking sector is now burdened with 10.4 trillion rubles in bad debt. That converts to approximately $136 billion. To put that figure into perspective, for the American taxpayer, that sum exceeds the entire pre-war annual budget. For Russia's national defense, this is not merely a cash flow problem. It is a systemic solvency crisis, hidden behind wartime censorship. Putin is attempting to finance a high-intensity war of attrition using a credit card that is already maxed out. And to understand the mechanics of this impending collapse, we must look inside the very institutions that are funding this disaster. The banks. To understand the mechanics of this collapse, we must move from the podiums of the Kremlin to the boardrooms of Sberbank, where the true cost of the war is being calculated, not in casualties but in unrecoverable capital. The disconnect between political ambition and financial reality was laid bare on October 28, 2025, when German Gref, the CEO of Russia's largest bank, issued a stark warning that the corporate sector was effectively entering a death spiral. His assessment is backed by a grim statistic, reported by Bloomberg in July. 23% of the total corporate loan portfolio in Russia is now classified as bad debt. That represents 190 billion in toxic assets, capital that has been lent out but will likely never return. This creates a paradox within the Russian economy. Banks are being politically pressured to issue loans to the defense sector to keep tank factories running, yet these loans produce no economic return. They are essentially financing equipment that is destroyed on the battlefield. Sources indicate that wartime decrees have effectively bypassed standard credit risk assessments, meaning up to 37% of the state budget is now tied up in high-risk lending that has zero commercial viability. The crisis is equally severe in the civilian sector. As inflation erodes wages, ordinary Russians are borrowing simply to maintain their standard of living. On December 5th, the Central Bank of Russia admitted that overdue consumer debt surged by 12.9%. In the first 10 months of 2025 alone, major lenders like VTB and MCB are reporting that their overdue debt has jumped eightfold since the start of the year, reaching 668 billion rubles. In a functioning market economy, this level of delinquency would trigger immediate regulatory intervention. In Russia, the solution has been to simply raise interest rates to suffocating levels, with the key rate peaking at 21% in October 2024 and holding at 16.5% through December 2025. The cost of borrowing has become prohibitive for legitimate businesses. Analyst Pavel Ryabov projects that corporate interest costs will exceed 15 trillion rubles, or 172 billion in 2025. This effectively chokes off any non-military economic activity, forcing small and medium enterprises to restructure 20% of their loans just to avoid immediate bankruptcy. The Russian banking system has effectively transformed into a captive lender for the state's military objectives, absorbing toxic assets to delay a broader collapse. But a banking crisis is only sustainable as long as the state has the revenue to bail it out. And thanks to American sanctions, that revenue stream is drying up at the source. While the banking sector erodes from within, the external lifeline of the Russian economy, energy exports, has been severed by a calculated dual-track strategy involving U.S. Treasury sanctions and precision infrastructure targeting. For decades, hydrocarbon revenue has acted as the primary stabilizer for the Russian budget. But in October 2025, that stability was dismantled. The U.S. administration implemented rigorous secondary sanctions on Russia's energy giants, Rosneft and Lukoil. Unlike previous measures, These sanctions targeted the buyers, effectively forcing major importers like India and China to reduce their intake to avoid losing access to the U.S. financial system. The impact was immediate. Export volumes contracted to approximately 3 million barrels per day, forcing Russia to sell its remaining crude at steep discounts. The market data confirms the efficacy of this policy. The price of Urals crude has fallen to $65.74 per barrel. According to a Moscow Times report from September 4th, this price suppression caused federal oil and gas revenue to plummet by 36%. In August 2025 alone, annualized this represents a revenue loss of approximately $31 billion. Capital that the Kremlin can no longer use to service its mounting war debts. Simultaneously, the physical infrastructure supporting this industry is being degraded by asymmetric warfare. Since January 2000, 25 Ukrainian long-range drones have executed a campaign targeting the specific bottlenecks of Russia's energy grid, the distillation towers. These complex components are essential for refining crude oil and are difficult to replace due to technology sanctions. To date, operations at 21 of Russia's 30 major refineries have been disrupted. This has created a supply-side paradox, where the world's second-largest oil exporter is facing domestic shortages, driving internal fuel prices up by 40%. To bridge this widening deficit, the Kremlin has been forced to liquidate its strategic reserves. The National Wealth Fund has been drained by 57% since the invasion began, with liquid assets falling to just 4.2 trillion rubles. Recognizing the systemic risk, Central Bank Governor Elvira Nabiullina mandated on December 1st that the risk buffer for high-debt loans be doubled, from 20% to 40%. This data demonstrates a high return on investment for Western policymakers. By combining financial isolation with the degradation of physical infrastructure, the capacity of the Russian state to fund its military operations is being dismantled at the source, leading to unavoidable macroeconomic consequences that are now rippling through the entire nation. The Russian Federation has transitioned into what economists classify as a zombie economy, a state where top-line activity is sustained solely by military stimulus, while the foundational civil economy atrophies. This internal cannibalization is now creating a fiscal imbalance that no amount of oil revenue can cover. The fiscal data for 2025 reveals the scale of this structural failure. The federal budget deficit has expanded to 2.6% of GDP, representing a shortfall of 5.7 trillion rubles. The rate of expenditure is particularly alarming. In the first 7 months of the year alone, the Kremlin burned through 4.88 trillion rubles, roughly $61 billion, exceeding its deficit targets for the entire fiscal year. Before the third quarter even began, this indicates a loss of fiscal control, as the state strips funding from infrastructure and social services to maintain liquidity for the defense sector. This massive redirection of capital to the military, which now consumes 6% of GDP, has triggered a classic crowding out effect. The civilian sector is being starved of resources. While official metrics place inflation at approximately 9%, the realized inflation rate for essential commodities, food, utilities, and logistics is tracking closer to 20%. This erodes the purchasing power of the middle class and suppresses domestic demand, a fact evidenced by a 20% surge in corporate bankruptcies. This year alone, despite clear indicators of overheating, the political leadership has chosen to double down. In July 2025, economic advisors, including Central Bank Governor Nabiullina, warned against further stimulating the economy. Vladimir Putin ignored this counsel. Furthermore, his rejection of preliminary land for peace negotiations, as reported by The Guardian on December 7th, confirms that the Kremlin is prioritizing territorial ambition over economic stability. This strategic obstinacy has resulted in a significant loss of economic sovereignty. With Western markets closed and domestic reserves depleting, Russia has been forced into an asymmetric dependency on China. Beijing now effectively dictates the terms of trade, purchasing Russian resources at below market rates, while exporting finished goods at a premium. Russia has not just lost its economic growth, it has been reduced to a resource vassal. And as we look toward 2026, the timeline for a total system failure is accelerating. To truly grasp why the Russian treasury is emptying at such a frantic pace, one must look beyond the macroeconomics and examine the balance sheet of battle. The war in Ukraine has evolved into a case study of asymmetric financial attrition, where Russia is spending millions to achieve what Ukraine counters with pennies. This is not just a military failure. It is a negative return on investment that no economy, not even one as resource-rich as Russia's, can sustain indefinitely. The most glaring example of this fiscal hemorrhage is the disparity in armored warfare. The T-90M Pro Revi, Putin's most advanced main battle tank, carries a unit cost estimated at approximately $4.5 million. It was designed to be the apex predator of the battlefield. Yet throughout 2025, we have documented dozens of confirmed kills, where these multi-million-dollar assets were neutralized by Ukrainian FPV drones. These commercial-grade quadcopters, modified with a simple RPG warhead, cost roughly $500 to assemble. Do the math on that exchange. Russia is losing an asset worth $4.5 million to a weapon that cost less than a decent laptop. That is a cost-exchange ratio of 9,000 to 1. When a Russian bank finances a defense contractor to build a T-90Ms, and that tank is destroyed 5 minutes after reaching the zero line by a cheap drone, that capital is vaporized. It yields no territorial gain, no strategic advantage, and zero economic return. It is simply a $4.5 million write-off that the Russian taxpayer must absorb. This financial asymmetry extends to the air war, which has become the single largest drain on the Kremlin's liquid reserves. In late 2025, Russia launched a series of massive missile barrages targeting Ukrainian energy infrastructure. A single Kh-1 cruise missile cost the Russian state approximately $13 million to manufacture. A typical salvo involving 100 mixed missiles and drones can cost the Kremlin upwards of $1.2 billion in a single day. For Ukraine, the cost of defense is high, but the cost of the Russian offense is astronomical. While Ukraine utilizes high-end Patriot interceptors, they have also integrated low-cost Franken-SAM systems and mobile fire groups, equipped with heavy machine guns to intercept the slower, cheaper Shahed drones. But for Russia, firing a $13 million missile to hit a transformer substation that costs a fraction of that amount to repair is a strategic blunder. It is the economic equivalent of burning down your own house. To kill a spider, the damage to Ukraine is real, but the damage to the Russian budget is fatal. Furthermore, we must account for the meat grinder economics. The staggering cost of personnel to maintain its current troop levels amidst catastrophic casualties. The Kremlin has been forced to drastically inflate recruitment incentives. As of December 2025, regional sign-up bonuses in Russia have skyrocketed to nearly $30,000, an amount that exceeds the average annual salary in many Russian provinces by a factor of 5. This creates a dual economic disaster. First, it drains the regional budgets, forcing the central government to print more rubles to bail out local provinces, which directly fuels the 9% inflation rate mentioned earlier. Second, it creates a labor shortage in the civilian sector. When a factory worker can make 5 years' worth of salary by signing a 6-month contract to dig trenches and donuts, they leave the assembly line. This worsens the labor crisis, drives up wages in the civilian sector, and ensures that the zombie economy keeps rotting from the inside. Perhaps the most humiliating financial sunk cost lies in the Black Sea. The loss of capital ships like the Moscow and the recent destruction of the Ivanovets missile corvette represent billions of dollars in naval assets that are effectively irreplaceable under current sanctions. Russian shipyards lack the specialized turbines and electronics. To rebuild these vessels, a corvette costing $70 million is destroyed by a Ukrainian Magura V-5C drone that cost perhaps $250,000. Again, the asymmetry is stark. Russia is not just losing ships. It is losing decades of naval investment that it cannot afford to replace. This is the hidden ledger of the war. Every time a drone hits a refinery, every time a missile misses its target, and every time a recruit signs a bonus check, the solvency of the Russian state is chipped away. Putin is fighting a 21st century war with a 20th century budget, and the math simply does not work. The battlefield has become a financial black hole, and it is consuming the Russian economy faster than the central bank can print money to fill the void. As January 2026 approaches, the Russian Federation faces a convergence of physical and fiscal challenges that its weakened infrastructure is ill-equipped to handle. The arrival of winter, with temperatures projected to drop to -13 degrees Fahrenheit, will act as the ultimate stress test for a system that has been stripped of capital reserves. The economic forecast for the coming year indicates a high probability of a stagflation scenario, a toxic combination of stagnant growth projected at barely 1%, in persistent high inflation, with interest rates likely to remain above 16% to defend the ruble. The private sector is effectively locked out of the credit market, making organic economic recovery mathematically impossible. Furthermore, the diversion of funds from municipal maintenance to the defense budget has left district heating systems and industrial plants vulnerable to critical failure. During the deep freeze, the strategic reality is that Vladimir Putin may retain the military capacity to prolong the conflict in the Donbas, but he has lost the war for economic viability. The state is now operating on borrowed time and borrowed money, with no clear path to solvency. This trajectory validates the long-term strategy of the United States and its allies by leveraging economic statecraft sanctions, asset freezes and energy decouplings. The West has successfully degraded Russia's capacity to project power. Without engaging in direct military conflict, the data confirms that patience is yielding a high return on investment. The Russian economy is not just stalled, it has entered a phase of irreversible structural decline. The facade of Russian stability has been dismantled by the data, but the timeline for the final collapse remains the critical variable. How long can a zombie economy function before the lack of liquidity triggers a total system failure? Let us know your analysis in the comments below. Thank you for watching.